Welcome everyone to the March FX client webinar. I'm Paul Robson. I'll be your host today. I'm head of FX strategy for Europe here at NatWest. I'm joined once again by Piers Leslie from Fact, Not Fiction, and we'll be running through our high-level thoughts about global currency markets. We will tackle this in slightly different ways. I'll be looking at macro fundamentals for insights into currencies, and as usual, Piers will be using technical analysis charts to see what the future holds for major currencies. Before I begin, I'd just like to remind people that this isn't investment advice. This is just broad picture views on where we think major currencies are going. The title of this month's webinar is Seeking Clarity in a Fractured World. And we chose that very carefully because it's clear that the world economy, political alliances, trade links, government policy is under huge strain. And it's a potentially potent cocktail for currencies. Currencies will move around. They will be the released valve for various stresses in the global financial system. And this year, 2025, has got off to a sort of breakneck pace, not least changes in the US sort of political system, whether it's Ukraine, domestically, government budgets, for example. And it's these that we're going to be looking at today in a little bit more detail. Okay, so in terms of my part, it's called a risk nexus, and there it sort of dials down into some of the things that I've already spoken about in terms of geopolitical shifts, defense spending in Europe, and it's clear that the world has become a more risky place. And when we think about currencies, we have our baseline forecast. Our projections are most likely case given our understanding of the world. We understand that other people will have different views of the world. And then around that, we think about the risks. And sometimes we think for certain currencies, the risks aren't particularly great. But for other times, we think the risks are sort of larger, and we have to spend more time thinking about that. And that's what I plan to do over the next sort of 10, 15 minutes. So unusually, because of that sort of focus on the risks around a central forecast, I put our FX forecast and rates forecast right at the front of the presentation. I'm quite often sort of told when listening to other presentations that people are unclear about the exact sort of forecasts and projections. And so I like to put those right at the front so everyone's clear essentially what our base case, and then we can talk about the risks. The next part will be just a quick sort of deep dive into what's been driving the pound sterling. And we think that there's 5 key factors that we need to be mindful of, and we can think about the risks around those. As usual, it tends to be for sterling yields, but we'll go into that in a little bit more detail. I'll then just provide a very quick update on the UK economic outlook, recent performance, what we expect going forward. I think people understand that pretty well in terms of the commentary. I don't think the outlook is shifting particularly quickly. So maybe I won't spend too much time on that, but you'll see some quite familiar charts that my colleagues on previous webinars have gone through. And then finally, we'll talk about some of the Pacific risks, and predominantly they're centered around Donald Trump 2.0. So as I promised, I put the forecasts right at the beginning of this presentation, so there's no sort of misunderstanding about what we're expecting, and largely they're unchanged from the year ahead. You would have listened hopefully to Imogen Bakra a couple of months ago, where she outlined our year ahead thoughts. But here are the sort of key numbers. The first one, UK growth 1% this year, not particularly great. It's a really challenging outlook for the UK economy. The UK probably grows, we think, in line with the Euro area economy, but noticeably slower, weaker than the US economy, that is set to grow almost 3 times as quickly. But there is, I think, increasingly the most uncertainty around that US growth outlook. If you look at some of the data for the UK economy over the last couple of weeks, it does seem to be deteriorating. So it'll be really interesting to see whether that shifts. In terms of the Bank of England base rate expectations, we're still at 4% for the landing zone of the monetary policy easing cycle here in the UK. Perhaps downside risks in 2026, but that's really going to be dependent on how the labour market performs. I think this is one of the key messages here, is inflation is just proving to be a bit more sticky than we and I think the central bank had expected. And it means that, unfortunately, interest rates in the UK just stay a little bit higher for a little bit longer, 4%. That's around where markets are, but there's a lot of other people who think that maybe something just above 3 might be a realistic expectation for the end of 2025. Turning to FX rates, sterling dollar, we think gets to somewhere between 130, 135 by the end of the year. That's towards the higher end of the consensus. If you look at the charts on the right-hand side of the slide where I've plotted my forecasts, along with what other people expect, so the Reuters poll that people might be familiar with, you can see that we're sort of at the top end of the consensus. In terms of sterling euro, we think a sort of modest upside risks to like 122. I think actually, just going back to sterling dollar for a moment, those forecasts look a lot braver, bolder, just like 2 or 3 weeks ago. So clearly markets are moving quite quickly. So Eurozone, we think just modest upside. I think from here, the risks are becoming a little bit more balanced in terms of sterling gains against the euro. As you can see from the chart on the right-hand side, we're a little bit more optimistic on sterling than the consensus, but not a lot. But what I draw your attention to this chart is just how wide the distribution of expectations are across various strategists and economists across the street. And I think that just highlights the increased risks around the UK and international economy, and it's causing uncertainty. In terms of some of these risks, I've sort of highlighted them in red because they are what we should be focusing the most on. I think for sterling, the number one risk remains fiscal policy. Just the sustainability of the UK's fiscal position, the impact of those changes from the budget 24 back in last November. I think that still key to how sterling trades. We think we're in a bit of a sweet spot for the currency, but that could easily change. For the dollar, we think the main risk is the impact of tariffs. Two-way, I think. It's not always broader, higher tariffs mean a higher dollar for longer, I think the market is challenging that view. And how those tariffs were implemented, general government policy towards getting the twin deficits down, I think that brings significant dollar risks for 2025. And then for the euro, it may well be that finally the balance of risks are shifting to the upside in terms of pessimistic growth forecasts that could be challenged, looser fiscal policy, defense spending, and those kind of things. So maybe the euro is set for a little bit of gains, particularly against the dollar. So I'll quicken up some of the through the slides now. This slide is just to remind people of the overall framework where we try to map the course for major currencies. This is what we set out back in November, and I think it's still very much in play, and I think these will be good friends when we think about currencies going forward. Remember the title of the year ahead, the policy pendulum, and this was all about we'd moved from a period of higher interest rates through a period of stable interest rates to lower interest rates, the terminal rates, the landing place of rates. That's still, I think, the focus, and I think that is still moving currencies. The second driver, and it's in sharp focus today over the last couple of weeks, and this is fiscal long COVID. This is the idea that government finances across the major economies are really quite stretched. Some people have more, greater scope than others to ease fiscal policy, and that's going to be, I think, important in shaping the year ahead in terms of currencies. Changing shape of free trade, just tariffs, people reshoring, friendshoring, moving production around the global economy. I think that's still extremely relevant. It's a key part of Donald Trump's policy. For Donald Trump, the deal maker, he's clearly going to be making deals, whether it's in Russia, Gaza, Iran, Asia. Clearly how these deals come about and what they look like will be fundamentally important for currency markets. And then the fifth one, this might be a little bit of a new one, just how the world is shifting from a unipolar world to a multipolar world where you've got different groups of countries leading, and you've got some that are multi-aligned, which will be really quite important. Moving on to the next slide, please. So these are the 5 drivers, the pillars, I guess, of any sort of forecast for sterling. And these are the 5 focus drivers that we're going to be using for the year ahead. And so the first one will be, I think, familiar: relative yields. Bank of England stays cautious, leaves rates high for longer. I think that's supportive against a range of currencies, although we might be just moving into a pivot point where those who've cut interest rates the quickest and have more fiscal room, those currencies might start to do a little bit better. But generally speaking, that's still supportive. The chart on the right-hand side shows the relationship between sterling dollar and relative interest rates between the UK and the United States. Fiscal policy risks, I've mentioned those earlier. I still think that when you've got a large fiscal or government borrowing, a high government debt stock, and high debt servicing interest rates, that's potentially a difficult combination, and that's definitely something that has to be watched. The third driver, I think, is stagflation risk. This is important because the UK runs a current account deficit, needs to attract foreign capital to balance the deficit. And here the news is slightly less positive. You've got weak growth, flatlining growth, and still high inflation, which might just dull the attractiveness of UK assets for international investors. The fourth driver is tariff risks. I think here the UK benefits from being mostly harmless. The UK runs a broadly balanced trade position in goods with the United States, and I think the UK won't be the main focus for US tariffs. And then geopolitical shifts, number 5. I actually think that that's turning a little bit more positive. It might help the UK become more relevant. It might help us align with different trading groups, which wasn't obvious just 6 months ago. Next slide, please. Very quickly, because I've taken up too much of the time already. So this chart on the left-hand side, this is my favourite chart to summarise all the UK data that we've had. You can see it shows the GDP expectations across economists for the UK, Euro area and the United States. And you can see the green line has been falling, implying that people have become less confident about the growth potential of the UK economy. The triangles are our expectations. And you can see that it's a similar case in Europe, but the US doing better. It'll be very interesting now to see whether that changes. For the UK, it's the same combination of a weakening labour market, cautious households, and a weak investment performance. So the right-hand chart here shows the weakness or continued weakness in the UK labour market. Employment is no longer growing, and occasionally we get job losses, unfortunately. Next chart, please. This was just to support the view that households remain cautious. So left-hand chart, rising savings of households as they become cautious. Right-hand chart, confidence. People are worried about the future. Maybe it's future tax increases, maybe it's the labour market, maybe it's international worries, but ultimately the economy, the drivers of the UK economy seem to be weak, and it's not clear to us what changes that anytime soon, and hence why we have a 1% growth forecast. Next slide. Now, this is the problem. Just in one chart, this is the breakdown of inflation in the UK. Inflation's obviously come down a long way, but it's proving persistent, sticky. It looks like we're going to get a little bit of a hump in inflation over the short term, mainly because of energy, utilities in this chart. The Bank of England is probably quite confident, or more confident, that the inflation won't be persistent because of that weakness in the economy, the labour market, but they can't be too sure. And having seen inflation turn out to be much higher than they previously expected, we think that they remain cautious. But the quicker inflation falls, the quicker the Bank of England cut rates. They can cut them below 4% and ease the pressure on the economy, and also get those government debt servicing costs down, which are eating up so much of the government's tax receipts. Just very quickly, because I'm sort of done my 20 minutes, this chart just shows, I think, one of the number one key focuses for the UK economy. What's going to be the impact of the national insurance rise and minimum wage increases? And here, for the Bank of England, it's going to be who pays ultimately. Will it be corporate profits through margins, or will it be households through lower employment, weaker wage growth, and inflation? And at the moment, it feels like it's going to be higher prices to begin with, because they're the easiest thing to bring forward. But ultimately, if that doesn't happen, then unfortunately we think maybe lower employment will be what happens, weakening the economy. Next slide, please. These are the 5 key risks, I think, for the outlook. I've talked a lot about UK fiscal policy. That's still our number one concern. The impact of rising European defence spending, the multipliers, the impact on growth, who pays, how it's paid for, who can ease policy the easiest, who can spend the more. That's clearly going to be important. Process of tariffs, changes in US policy globally, number 4, and then Donald Trump's dash for deals. I think I'll leave it there, and I think we can move on to Piers Leslie.
Hi there. Right, well, as Paul said, I look at the markets in a different way. I look at them at just what price is doing. I think everything's in the price. So if everything's in the price, if we look at price, we'll know where everything's going. A lot of people, I feel, are under the misconception that markets and events are driven solely by fundamental laws and news when it comes out, meaning that you can't predict turns and where stalls will be, and you can't time them, you can't predict where they'll be. From my 35 years of studying markets, I believe charts tell us otherwise. They're around way before modern day economics, just not as widely publicized. Hopefully, you'll see on this presentation, markets are driven purely by mathematical order and history, as it's normally the same sort of patterns, retracements, and cycles that happen time after time. Hopefully, you'll see that in this presentation. So let's go to the first slide. This is a slide that I had last month. I was saying that we were just entering the year of the snake, and I was saying it's important to know, in the West, we sit and we look at our part of the world, but it's important to know what Asia and what they sort of think. So it's important, I said, to understand what each year symbolizes. And so for the Chinese year, this year was the snake, and I said, the thing I highlighted was their potential high volatility and hidden risks and sharp losses. And I think that's really paid out over the last few weeks. We've really seen a lot of two-way volatility in many financial markets. Hidden risks have come out, and they've probably caused some sharp losses and some good gains. But I think that's why I think it's good to look at what different cultures can teach us, rather than just sitting looking at what we feel in the West. So that, I think, is just to sort of say why I sort of show these things. I think it's playing out well already. And I think that volatility will stay. It's not the month of the snake, it's the year of the snake. So let's go to the next one. So this is the chart we looked at last month on the monthly candle, and I've updated it onto the next slide. And I was saying last month that, if we go to the next slide, please, we'll see. Yeah. So on this, I was saying that there was a resistance at the 110 area, which was a 76.4 retracement on the yearly chart. And I highlighted the importance of 106 as an area of support. Now, last month saw that 106. I think if we zoom to the next one, you'll see it zoomed in a bit closer there. So you can see, hopefully, these levels a bit clearer. So you can see last month, we sort of held that 106. Price went down, tested it, it bounced back up higher. The buyers bought it. But this month, it's collapsed down through that 106. So I said that if we broke below the 106 area as support, it would suggest dollar weakness arriving in this move and open up the 61.8% to 76.4% area of 102.50, 103. And that would be an important area of support to watch. So what else have I added on here? I've added that yellow sort of coloured in part, and that's called the Ichimoku cloud, which is basically just a historical lagging moving average. But it acts very well as a cushion. When price is above it, it comes down, it acts as a cushion, sort of holds price. And you can see it's just sort of stopping price on this initial move down. I also have the 20-period moving average, which comes in around 104.80, that pink line. So I think during this month, I'll be very interested to watch as the month progresses. How are we against that 104.80? Does it look like we're going to break below the 20-period moving average, or will price hold that into the end? And then, is there going to be any impulsive move out of this sort of 61.8, 76.4 and the Ichimoku cloud area? Are we going to find some support and push it back up? So it's always important to know where things have completely changed. And last month I said, where the world has changed on this is if you get below 100, because you've taken out that 61.8, 76.4, you've taken out the cloud and broken back below the downtrend line, which we broke above the end of last year. So there should be good support in this 102, 104 area. And that's what I'm going to watch this month. Will any support come on there? What about the upside now? We can move down from that 110 because it's too far away, and we can look, let's say, at the 107 area. So 107, I think, is resistance. That was a 23.6, came in at 107. So I think moves back up. Yes, that 106 area, that will be the initial resistance. But to get positive and to lose this negative sort of feel that it's had this month so far, price needs to get above 107. And while it's below 107, the pressure will stay on that downside on the dollar index. So let's go to the next slide. So this is sterling dollar. And last month, I summarized sterling dollar at the end saying, instead of praying to the gods as we shuffle the decks, why don't we try and figure the odds by using a quarterly rolling check? And I said, use support at the moment as 121 to 122.5. That was the support zone. So down there as support, it's where the market should buy. And I said, while above that, let's see how far the rally can get. There should be resistance in the 127, 130 area. Well, with this high volatility and everything like that, if we go to the next slide, we can see we're up in that 127, 130 area. So that's an important thing that you've done it so quickly. We bounced off the low, I think, we've seen has been around 122.5, so that support worked well. And the resistance at the moment, you're coming into it. So we've got to see how does that resistance work. You know, we had that 120.90 area, which I had on my weekly charts as the support line. And those three black circles showed, remember to look left. It's where it always had bounced before. So let's go to the next slide and sort of see another way of looking at it. This is a monthly chart. And on this, I look at the retracements of the rally from 2002 to 2024. Now, you'll get these slides. So if you're watching on a small screen and you can't really see where that comes in, the green line go across with the little star is the 38.2%. And that's at 122.57. So that's why I was saying on the previous, when I was talking previously about the importance of the 122.5 area. It's the 38.2%. And the amount of times I tell people, you've got to know where the 38.2% is. And that's why it's important. It had 2 months of testing it, and this month has really rallied higher after it sort of failed to break there. So you've always got to look left on these charts. When you look at a chart, look left. What happened in the past? Now, there's another thing that we have. Those three black circles, they're quite important because that formed a trend line. There were 9 monthly bounces off that trend line in those three circles. We're down below the trend line, rallying back up towards it. So that trend line comes in around about in the 130s. So we've got to watch as you get back up to there, is that going to be an area of resistance? So we had that sort of 127, 130 area to watch. And that's another reason just sort of why people might sell it as it retests the trend line called the rule of polarity, old support and resistance switch. And the last thing I'd just say on here is the higher highs and higher lows. I was saying look left on the other side, look left on this, and I've highlighted the highs have been consistently higher and the lows have been higher. So on this move higher, if you want this sterling dollar trend to continue higher, you need to see it break up and make a new high without coming back down and taking out the previous low. So that's a very important thing just to keep an eye on. So there's one last thing actually, which it's not in the body of the chart, it's underneath. I put a red circle last year, and when we did these monthly charts, saying the slow stochastic had a negative cross. The lines had crossed and they were pointing down, negative cross, and sterling dollar just collapsed from that point into the end of the year. It was also the 8-year cycle, so we knew sterling dollar was going to end lower than it opened, and it did again. But this year, we're seeing those lines come very close together, so maybe they're about to cross. Now, if they cross, that will be a big boost for sterling dollar. They haven't quite crossed at the moment, and you want confirmation they've crossed. So we're going to look at that next month. Did those lines cross, and are they holding as a cross? But what do we see from this chart? We can see 122.5 remains the key area on the monthly chart as support. You're going up towards sort of 130, that trend line. If it gets towards that trend line, we've got to sort of expect some sort of price action to sort of have a risk that it starts to fall back off it. On the initial test, it might break through it, but on the initial test, it should stall. Right, the next slide. This is my weekly chart. You know, I send out the weekly charts, and in January, mid-January, we had the cross at the bottom of the chart. Like I've just been talking about, the slow stochastic, I highlighted on that, you'd crossed. And so that was positive. And all sterling dollar has done is rally since then. Now, we put on here the retracements of the fall down from 134. So last September, it was up at 134. It fell down to 120, 121 area, really. Now, with those retracements, it stopped for the last 3 weeks. It's been stalled at the 38.2% and by the base of that cloud. But what are we seeing this week? An immediate attempt to get away from that 38.2% and a rally towards the top of the cloud. What can we have on there? We have 129.25 to 61.8%. You have the top of the cloud around there, and we have 76.4% at 131.20. So that's where life will come a bit tougher for this sterling dollar rally as it approaches that 61.8, 76.4% area. So the other thing we can look at is let's move a closer support up from 122.5 because that's some way away now. So I would say now you can look at the 38.2%, that 126.10 and the 125.60 and use that as a pivot as the month goes on. So while it can hold above 125.60, 126.10, then it's still in positive move. Any move below 125.60 on the weekly chart would start to call in, where have all the buyers gone? What's happened? Has it not managed to break through that cloud? So those are the sort of levels I'd watch at the moment, 125.60, 126.10 against 129.25, 121.20 resistance. If we go to the next slide, we've got the daily sterling dollar chart. So on this, you have the downtrend, which is the black line coming along. Now, this is what I send out each day. You would have got this because all these are things I've taken off the daily chart. I think the interesting thing for me was in mid-January, well, the first part of January actually, we had a hammer candle. And I highlighted that on the daily chart saying a hammer candle should hammer out a base. And that's exactly what it did. Ever since the hammer candle, you've never had any move lower in sterling dollar than that hammer candle. It has hammered out the base. But as it rallied back up, it broke through the downtrend. And what it's done is simply formed an upward channel. So you can see those two pink lines, prices at the bottom, goes to the top, falls to the bottom, goes back up towards the top, falls to the bottom, goes back up towards the top. And this morning I said, look for price to stall as it reaches that top of that channel. And it has. You can see there's sort of been a spike off the top of that channel. So the traders are watching that. That's what they're trading. But the important thing is that channel could be just breaking through the Ichimoku cloud. So we've seen the price breakthrough, but the lagging line, if you look, there's a line to the left, an orange line. It's gone through the yellow cloud. So that's a confirmation normally that it's a good break. And so you'll probably find some more. If that holds above the cloud, like today it's just breaking through, but you want to see it, any move back down be held by the cloud and that lagging line continue up. If that happens, then that's positive for sterling dollar. What else do we know? We know using this chart on the daily, we can be a bit quicker than waiting for the weekly and the monthly chart. If price comes down below the bottom of that channel and breaks below the channel, it would increase pressure on the downside. And what we'd have to think about is, why has it broken the downside? Why has it broken back below there? So I will be doing that on the daily charts if we do see a break below. But that's, while you're in the upward channel, life is good for people who want sterling dollar higher. Any break below the upward channel, any break to the downside would start to raise some concerns. Right, let's go to the next slide. this is from last month's webinar. I call it the battlefield map. It's been very simple for sterling euro. I mean, you haven't had to do anything. You've only had to watch 3 lines in sterling euro and you'd have got it since Brexit. You won't have to worry about any of these. Are we doing Brexit? Is this getting done? Is there a new prime minister? Is there any? None of that. Not what inflation's doing, not what interest rates doing. Every time it's reached that 38.2%, it's fallen off it. So that's where the sellers just sell it. Oh, we've made our money. Goes down the bottom. It likes the mid, the 23.6. It likes that to pivot round. And when it goes to the bottom, you can see 5 times it's bounced off that bottom line. So 5 times off the bottom line, 4 times off the top line. Top line 121.5. The midline at the moment is 116. So that gives you the big areas to watch. And on the next slide, I should have said this first of all. Let's go to the next slide, because the next slide is it just updated, and you'll see it's just held again. So it is very simple, sterling euro. Just keep watching that map. This chart is a battlefield map. That will show you the big picture. But let's go to the next slide where I look at the monthly chart. So on the monthly chart, we can see that price is just stalling at the 76.4%. Now, the 76.4% comes in around 121.60. Now, if you remember that 38.2% from the other chart was 121.50, what does that tell you? 121.50, 121.60 is a key area of resistance. You've got a few people saying that. If you start to get above there, then things change and sterling euro should be going higher. But at the moment, I'd watch that as resistance. Support, as you come down, you can use those extension levels I've got on there, the 120, the 119. But the one that really interests me is the 38.2%. So that comes in 117.80 area. So the 117.80, 180, 118 area, if you start to get below there, then you start to think, what's happening to this run higher in sterling euro? Is it starting to sort of struggle? And on the next slide is the weekly chart. And I think it's just worth looking at this weekly chart, because this is what I've been sending out for some time. Well, since 2023, we've had that trend line really going up. Every time in those blue circles, it's hit that trend line. It's just been bought. And this is what I'm saying about markets are mathematical. I can't believe that something was announced every day that it hit that trend line. But every time it hit that trend line, impulsive bounce off it and went higher. What it has to do is keep making higher highs for that trend line to be intact. So we need to see a bit more move higher here for sterling euro. If it starts to come back off, that might be a bit of a concern if it comes back, especially if it breaks that trend line. But so at the moment, you're in an uptrend. But to continue that uptrend, I'd like to see it go through that 38.2, which is 122.20. Above 122.20, I'm happy. Sterling euro's going higher. Probably see 124, 125. But you need to break through that area. If it comes back down, you need to see an impulsive bounce off that black line like we have in the past. You've had the cloud cushion it as well. Every touch of the cloud has produced a bounce as well. So that's your support area. And that, if you see, is about 117.50, 118. Isn't that strange? That ties in with the other chart. So it really shows it's the same levels, just to keep watching. As I said, very mathematical. Anyway, with that, it's the next slide. Just to say, these are only our opinions. They're not advice or anything. But I hope you found that useful. Any questions, please contact me or your salesperson. Cheers.